Now let us move to the last reading of study session 9, which is non-current or long-term liability. Under this LOS, we are going to determine for the bonds the initial recognition and measurement and subsequent measurements. Then we'll discuss the effective interest rate method, and accordingly we'll calculate the interest expense, amortization of bonds at discounts of premiums, and interest payments. We'll also understand the derecognition of the debt. Then we'll look at the role of various covenants, which could be positive or negative, in protecting creditors. We'll also discuss the financial presentation and disclosure relating to debt. Then we'll discuss the motivation for leasing assets instead of purchasing them. So we'll compare financial and operating lease and understand the difference between these two from the perspective of leaser and leasee. Then for financial leases, we understand initial recognition and measurement and subsequent measurement. Then we'll compare the disclosures relating to financial lease and operating lease. Then we'll look at various kinds of pension plans. For example, defined contribution and defined benefit. We'll compare the disclosures relating to both of these kinds of plans. And then finally, we'll calculate and interpret the leverages and coverage ratios related to long-term liabilities. So let us start. Bonds, which is the long-term liability, is a debt investment in which an investor gives the money as a loan to an entity, a company or government, that borrows the fund for a purpose for a specific period of time at a fixed interest rate. Now that is why bonds are referred as fixed income securities, and these are one of those three main asset classes: stock, cash equivalent, and third is bond. So as we know, the bonds involve two kinds of payments. One is periodic payment, which is interest payment or coupon payment, and the second one is face value of the bond, which is paid at the end of the bond expiry. Now let us look at few terms which are associated with the bonds. First is face value. So this is the value of the bond which is to be redeemed at the maturity or expiry of the bond. Second is the coupon rate. This is the rate at which the interest is paid, and it is calculated at par value or face value and not at the market price. So suppose coupon rate is 5%, that indicates 5% of the face value or the par value of the bond. Third term is market interest rate. So this is the interest rate which is demanded by investors in the market according to the perception of risk and reward relationship in the market. Fourth term is the effective interest rate. So this is in the context of particular bond. So while the bond was issued, what was the market rate? Since when we use this effective interest rate, the present value of all future cash flows of that particular bond becomes equal to the market price of the bond at the time of issue, which is issue price. Let us move further. Now recognition of bonds. We know at the balance sheet the bonds are recognized as a liability which is created equal to the proceeds received. So when the bond is issued, certain proceeds are received or the price of the bond. According to that, the liability is created. And on the income statement, since we know that periodically the interest is paid on the bond, so interest expense is recorded on the income statement, which is calculated as issue cost into market interest rate at issuance. So this is different from coupon rate. Since we know that the coupon payment is par value into coupon rate, whereas the interest expense is issue cost into market interest rate at the time of issuance of the bond. And finally, on the cash flow statement, the cash flow from operating activities will be reduced by interest payments, since we are assuming that interest payments are under operating activities. Cash flow from financing activities will be increased at the time of issue. While the bond is issued, there will be a cash inflow, and when the bond is retired or matured, there will be cash outflow by principal payment at maturity. So cash flow from financing activities will be decreased by that amount. Now let us look at the measurements of different parameters regarding bonds. So let us take first case where we know the bond is issued at par value. So the par value or face value is equal to the market price at issue of the bond or issue price. So this can happen only when the coupon rate is equal to market rate. When there is a bond which is paying coupon periodically equivalent to the market interest rate, that will be traded at par value. So in such cases, this is how we do the measurement. First, the liability is created equal to the proceeds, in this case which is going to be equal to face value. So suppose it was a $1,000 bond, say for 5 years, and the coupon rate is 5%, which is equal to the market interest rate. So this is going to be recognized in the balance sheet at face value itself, at $1,000. Over the life of the bond, the liability is stated at the par value, so which will remain $1,000. It is redeemed at the par value at the time of maturity. After 5 years, the bond is going to be redeemed at say $1,000, and every year there is going to be an interest expense which will be book value, which is $1,000 in this case, and the coupon rate, which is same as market rate. So $50 is going to be the interest expense throughout the period. So the treatment for interest expense and book value is very simple for the bond which was issued at par value. But there will be a difference when we are talking about different other bonds. So let us look at the case of bond which is issued at a discount. Since the coupon rate which is given by the bond is less than market rate, the bond will be issued at a discount. For example, if the par value is same as earlier, $1,000, and coupon rate is say 5%, but the prevailing interest rate in the market interest rate is say 6%. So we know that this bond is paying less than the market rate. So that is why the market price of the bond or issue price of the bond is going to be less than $1,000. Say it is $900 for simplicity. So in this case, the book value is going to be equal to present value of future cash flows, which are discounted at market interest rate. So we can calculate it. The present value of all the coupons, which is going to be 50 divided by 1.06 for the first year. Suppose it is for 3-year duration. Then 50 divided by 1.06 to the power 2. Plus in the final year there is going to be principal payment plus third coupon. So 1.06 to the power 3. So this value will give us the present value of future cash flows, which is going to be equal to book value, and it should be equal to the issue price also in the starting. Then liability is created according to face value minus discount. If we calculate, this value is say 973.2. So this is going to be the market price, 973.2. So which is our book value, 973.2, and liability is created equal to face value minus discount. So we know the face value is 1000 and discount will be 1000 minus 973.2, which is 26.8. So again same as present value. So liability is created at the same value. It keeps increasing periodically as the discount is amortized. Since we know that for the first year 26.8 is the total discount, this will be amortized over the period of 3 years. So that amortization has to be taken into account. Every year the liability will keep increasing and finally it will reach face value, that is $1,000, and at the maturity this is going to be redeemed at par value. And when we do the calculation for interest expense, we are going to use book value for that period since the book value will keep changing, into market rate at the issuance. So at the issuance, suppose the market rate in this case was 6%. So we are going to use 6% for the interest expense calculation throughout the period. Now let us look at another case where the bond is issued at a premium. So here the bond is giving coupon rate more than the market rate. So that is why it is being issued at premium. Suppose it is a $1,000 bond for 3-year period. This was the face value or par value. Say coupon rate is 5%, but the market rate is 4%. So this is paying more coupon, so that is why it is being traded at premium. So what should be the issue price or market price? It is going to be equal to present value of all future cash flows. So using time value of money, we can calculate. It is going to be equal to 50 first coupon divided by 1.04 plus 50 the second coupon, 1.04 to the power 2, and third coupon plus the principal, so 1050 divided by 1.04 to the power 3. Or we can simply put these values in financial calculator. We can find out the present value, which comes out to be 1027.75. So this is being issued at a premium of 27.75. So in the face value is 1000, so premium is 27.75. So here the book value is going to be present value of all future cash flows discounted at market interest rate. So we have discounted at 4% here. So this book value is going to be 1027.75. The liability is created equal to the face value minus premium plus premium in this case. The face value is 1000, premium is 27.75. So liability is same as book value 1027.75. Then this liability of 1027.75 keeps decreasing periodically as the premium is amortized. Since we know that 27.75 is the premium that has to be amortized over the period of 3 years. So every year the book value or liability keeps coming down, and the final year it is going to reach 1000, which is par value. So it is redeemed at par value on maturity, and the interest expense will be calculated on the book value, and the market rate at issuance, which was 4% in this case, will be used. So we are not going to change the interest rate with time, but we'll use the same interest rate which was at the time of issuance of the bond. And as we know, the book value is going to change every year due to the amortization of premium. Now let us look at the treatment of interest. When bonds are issued at a discount or premium, there are two methods of amortizing discount and premium. The first method is effective interest rate method, in which we know the market interest rate which is applied to calculate the interest expense, and this market rate is at issuance. So market rate at issuance into the carrying value of the bond, which is book value of the bond for current period. As we have seen earlier, that if the bond is issued at discount or premium, there is going to be a premium or discount which has to be amortized over the period of life of the bond. So one way of amortizing it is effective interest rate method based, which is required under IFRS and preferred under US GAAP. So it is not mandatory under US GAAP, but still preferred, and it is mandatory under IFRS. And the second method is straight line method. When we know the total amount to be amortized, which is discount or the premium, they are amortized evenly over the life of bond. Suppose it is 3 years, so we simply divide it by 3. As we have seen in the example, that 27.75 was the premium for 3 years. So under straight line method, we just divided by 3 and we get $9.25, which will be our amortization for each of these 3 years. Now let us look at the reporting of these interest payments. Under IFRS, the interest payments can be reported as cash flow from operating activities or cash flow from financing activities. But as we know in the US GAAP, the interest payments are categorized as cash flow from operating activities. So they have to be reported accordingly. So the interest paid has to be disclosed separately since that will be different, and the amortization, which is a non-cash expenditure, has to be added back when we are calculating CFO. So from net income, when we are calculating CFO, the amortization expense has to be added back since it is a non-cash transaction. Now let us look at one example to clarify the issue. Suppose there is a company which is issuing $10,000 bonds at 10% for 3-year period at this price. So this is at discount. The market rate is 12% and coupon is 10%. So this bond is paying less than market rate. That is why it is being issued at a discount. So calculate the interest expense and book value for 3 years using effective interest rate methods. We know that there is a discount involved here. Discount is 10,000 minus 9519.63. So that will come out to be $480.37. Now this discount has to be amortized over the period of 3 years. And since we are using effective interest rate method, we are going to use carrying value or book value of the bond and the market rate at issuance. So market rate at the time of issuance is 12%, which is to be used. So let us start. This is carrying value at beginning of the period, interest expense, interest payment, amortization, and carrying value at end of the period. So let us start. In starting, the bond was purchased at 9,519.63. So this is the present value of all future cash flows, which is equal to the market price. So this is our book value at the starting of first year. Now, when we have to calculate the interest expense, we need to multiply this carrying value by 12%, which is the market interest rate. So if we multiply it, we get this figure 1142.35, which is our interest expense. Now we know that coupon rate is 10%. So every year the company is going to pay 10% of par value, 10% of $10,000, which is $1,000. So this is being paid. So this is coupon payment. The company is not paying 1142, company is paying only 1000. So rest of the amount 142.35 has to be amortized. So this is amortization. So amortization means it is added to the liability. Since we have not paid the interest what we are supposed to pay, the remaining amount is added to our liability, which was carrying value 9,519. So when we add 9,519.63 to 142.35 from here, we get 9661.98, which is our carrying value at end of period. So this is carrying value at end of first year or beginning of second year. So this value is put here. Now let us see what happens in the second year. Again, the interest expense has to be calculated based on effective interest rate method, that is carrying value into market rate at the time of issuance. So 12% into this number, we get 1159.43. So this is our interest expense. But again, the company has paid $1,000, which was the coupon payment. So the difference between these two is 159.43. So this is the figure that has to be amortized or added to our liability, which was at the beginning of the period. So again, 9661.98 plus 159 is 9821.42. This is the carrying value at end of second year and beginning of third year. Again, the same story. For third year, we calculate the interest expense as 12% market rate, which is more than 1000, which was coupon payment. So 178.57 is the difference that has to be amortized. And if we add this value to our carrying value in the beginning of the period, we get this number, which is nothing but $1,000 is par value of the bond. So in the end, we reach this number after amortization for 3 years. So the bond will be redeemed at this number, 10,000. So we can similarly perform amortization in the case of a premium bond, where we'll start with a higher number, say 1000, 10,027 or something, and it will keep coming down as we are amortizing, and finally we'll reach the same 10,000. So we can perform amortization even in the case of premium bond in the same manner. Now let us move to the next topic, which is reporting of debt. So the company has the option to report the liability at fair value, since the value of the bond keeps changing. So the liabilities can be adjusted according to the fair value, and if there is a difference, then the gains or losses will go to the income statement. So this process is permitted under both IFRS and US GAAP. So according to the analyst, if the market value is lower, then that will signify a positive indicator. So market value of debt is a better measure, and if it is lower, then it's a positive indicator. So the company will not need to pay as much now because the market value of debt has come down. So it is a positive signal for the company. Now let us move to the next slide. Derecognition of debt. So derecognition of debt or redemption of debt can happen either at the maturity of the bond, when bond has completed its life, or even before maturity. So when the redemption of the bond is done at the maturity, the carrying value becomes equal to the face value, as we have seen in the case of discount bond. No gain or loss is reported. Since the carrying value is equal to the face value, there is no loss or gain, and it is reported as cash outflow from financing activities. So since we are redeeming the bond, we are paying back the amount which we have borrowed. So it is a cash outflow and it is a financing activity. Now let us look at the case when the bond is redeemed before maturity. So in that case, the carrying value is going to be different from the redemption value. So there has to be a gain or loss which is to be reported in the income statement. And on the cash flow statement, the net income is going to be adjusted to remove the effect of gain or loss, and the redemption value is reported as cash flow from financing activity. Under US GAAP, the unamortized issuance cost is written off at the time of redemption, and it is included in the gain or loss on debt extinguishment. Whereas in the case of IFRS, the issuance cost is part of carrying amount of debt on balance sheet. So that becomes a part of the total amount of debt on the balance sheet. And the further details about the extinguishment of debt are discussed in management discussion and analysis component of the financial statement. Now let us move to the next slide. Covenants. So with the debt or bond, certain covenants are attached, which are nothing but the restriction placed on the issuer to protect the investor's position. So the lenders or fund providers put certain restrictions on the company which is borrowing, which is known as covenant. So they could be of two types. One is affirmative covenants, another is negative. So affirmative covenants are the ones which restrict the user by imposing certain conditions to perform something. So the investors are expecting the company to do certain activities. For example, they are expected to maintain certain ratios which are prescribed by the investors, or they are supposed to maintain a particular amount of collateral, or there is a minimum amount of return which has to be maintained. On the other side, there are negative covenants where the bond issuer is prevented from taking certain actions by the investors. For example, the company is restricted from using further debt, so they cannot issue further debt, or the restriction from making certain investments which are, say, riskier investments, and even the lenders can also refrain from paying dividends. and it is also established in the bond indenture that if there is a violation of these covenants, it might amount to breach of contract and may lead to a penalty which has been decided by the lenders in the starting itself. Let us look at the next slide. The presentation and disclosures. So for a long-term liability, the presentation is made as single line item in the balance sheet, and if it is debt due within 12 months, it is shown as current liability. Then it is not qualified as long-term liability, it becomes current liability. And the disclosures which are supposed to be made in footnotes are the amount of future cash flows, the timing of the future cash flows from these bonds, the effective interest rate, the maturity of the bond, what are the covenants associated with the bonds, and the debt repayment schedule for next 5 years. And if there are any other provisions on the bond such as call option or bonds are convertible, so those provisions are also need to be disclosed in the footnotes. Now let us move to the next topic, which is lease. So lease of an asset is an agreement between two parties. One is the one who is providing asset, which is called as leaser, and the second one who is using the asset is called leasee. So leaser is the owner of the asset and gives the right to use for the asset to the leasee for a specified period of time and at a specified condition. Now the question is, why do companies go for leasing the asset instead of buying them? So it is less costly financing. So if the company tries to buy all the assets, then it will be more costlier than leasing, because leasing involves small amount of down payment and lower interest rates. The second motivation is reporting advantages, since operating leases are more advantageous in reporting since they improve the ratios. So that is why they are preferred. Third is the tax advantage. And fourth is the less risk of obsolescence. So if the company is buying the asset, the company is taking the risk that the asset might get obsolete. So if it is not buying, only taking it as lease, then there is a less risk of obsolescence. Now let us look at various kinds of lease. Broadly, there are two types of lease. One is financial or capital lease. Another is operating lease. So let us look at financial lease. It is a direct purchase of asset by leasee from the leaser. So leaser is directly financing the lease. So the one who is selling the asset is also providing finance to buy the asset. So there are different criteria for classifying a lease as finance lease. Under IFRS, the definition goes like risk and reward of the ownership of the asset should be completely transferred to the leasee. So in that case, it will be called as finance lease. And under US GAAP, if one of those conditions are met, then it will be called as finance lease. And these conditions are: first, the ownership of asset is transferred at the end of lease. So if this is fulfilled, then it will be called as finance lease. Or the second condition, which is leasee has option to repurchase the leased asset at a bargain price. So in starting, the leasee has got the asset on lease, but later it has an option to purchase the asset at a bargain price. So in that case also we can classify it as capital lease. Third condition is if the lease term is more than 75% of the useful life of the asset, then also we can categorize at capital lease. Fourth condition is if the present value of lease payment is 90% or more than the fair value of leased assets, then also we can categorize it as capital lease or finance lease. And finally, for the lessor, apart from the above criteria, he should also meet the revenue recognition requirement. If that is being done, then also it can be classified as finance lease. If you look at operating lease, it allows the leasee to use the asset for a period of time, and in exchange it will pay periodically. So under operating lease, the leasee is not going to show the asset in its balance sheet. It is not going to depreciate the asset in its income statements. It is going to show only a payment, which will be a operating cash outflow. So that will have a positive impact on certain financial ratios. We will understand them in subsequent slides. Let us look at the treatment of lease from leasee's perspective. We are talking about the finance lease or capital lease first. Under this, the assets are treated as purchased. So for leasee, they will enter into the balance sheet of the leasee. So lower of present value of cash flows or fair value of the asset, lower of these two numbers is reported as asset and liability on the balance sheet. Since it is a finance lease, so the liability and assets are created simultaneously in the balance sheet. Then the asset is depreciated and the depreciation goes to income statement. So it is being treated as a purchased asset itself. Then the interest expense is recognized as in the income statement. The lease payments are treated like amortization of the debt, since we are taking it as a liability. So we amortize it as in the same way as the debt. And on the cash flow statements, the lease payment from a capital lease is divided into two parts, interest and the principal. So under US GAAP, the interest goes to CFO, cash flow from operating activities, and the principal goes to cash flow from financing activities. And as we know, under IFRS, the interest can be treated as cash flow from operating activity or financing activity. It can go to either of them, but the principal has to go to cash flow from financing activities only under both IFRS and US GAAP. Now let us look at this finance lease from leaser's perspective. So under US GAAP, it can be classified as sales type or direct financing. So if the present value of the lease payments is greater than current value of the asset, then it will be called sales type. And if the present value of the lease payments is equal to the current value of the asset, then it will be called direct financing. So under sales type, sale is recognized as a present value of future cash flows. Since there will be a difference between the present value and the sale, there will be a profit or loss. So COGS, cost of goods sold, is recognized as the carrying value of the asset, and the difference is going to be the gross profit. Then the asset is removed from the balance sheet and lease receivable is created equal to present value of future payments. Then the interest received is recognized on the income statement as income, since we are looking from the leaser's perspective. And on the cash flow statement, the interest received will be a cash inflow from operating activities, and the principal reduction will be from investment activities. From a point of view of leaser, it is going to be an investment. And if the present value of lease payment is equal to current value of asset, then it is going to be direct financing. So there will be no profit realized, and the asset is removed from the balance sheet, and the lease receivable is created equal to present value of future payments, same as the case earlier. And even the interest is recognized on the income statement. And in the cash flow, the interest received is cash flow from operating activities, and the principal reduction is cash flow from investment activities. It is also same as sales type. Now let us look at IFRS. According to International Financial Reporting Standards, only sale type lease is allowed where the present value is greater than current value of the asset. Now let us look at the operating lease. So from leasee's perspective, no asset is recorded on the balance sheet. So this is different from capital lease, where we have assumed the asset to be equivalent to the purchase and we have entered that into balance sheet. Lease payment is treated like rent expense and recognized as expense in income statement. So in the case of capital lease, we had two components of lease payment, interest and principal, and it was put accordingly. But here we have only one component. On the cash flow statement also, we have only one component, which is cash flow from operating activities. So since the asset is not on the balance sheet, we are not considering depreciation, etc. And the lease payment is only rent expense and cash flow from operating activity. Now if we look at from leaser's perspective, then the asset will remain on his balance sheet, the one who has provided the asset to the leaser, and in his accounts the asset is going to be depreciated as usual, and the lease payments will be recorded as income on the income statement. Same as here, in the case of lease it was an expense, and in the case of leaser it is income, both on income statement. And similarly on the cash flow statement, it will be considered as cash flow from operating activities. For the leaser it will be cash inflow, for the leasee it will be cash outflow. Now let us look at the impact of financial lease and operating lease on financial statement and different ratios. So let us look at the profit in early years. When we have finance lease, we know that it is going to enter our balance sheet in assets and liabilities. Then it is going to be depreciated, which will not be the case in operating lease. In operating lease, the asset is not going to be depreciated. So that is why the profit in early years is going to be lower in finance lease and higher in the operating lease. Let us look at cash flow from operating activities. Again, it is higher for finance lease, since only the interest component is reduced is the outflow. But in this case, the full lease payment is a cash flow from operating activities. It is more cash outflow from operating activities in the case of operating lease. That is why total cash flow from operating activities will be higher for finance lease and lower for operating lease. And there will be opposite case in the case of cash flow from financing activities. Since it is finance lease, there is cash outflow of financing activity, since there are two components of the lease, interest and principal. So the principal will contribute to cash outflow of financing activities, which will reduce the cash flow from financing activities. But that will not be applicable in the case of operating lease, since the cash flow from financing activities are not affected. They are going to be higher than that in finance lease. Now let us look at the assets. Since in finance lease the assets are entered on the balance sheet, the value of asset is going to be higher than operating lease. Similarly, even the liabilities will be higher in finance lease as compared to operating lease. If we look at return measures, for example return on assets, etc., they will be lower. Since our profit in early years is lower, so they are going to be lower, and they are higher for operating lease. Since for operating lease the profit for early years is higher and the assets are lower, so the ratios will automatically go up. And if we look at the solvency ratios in early years, we know the assets are higher, so debt to asset ratio will be higher, since both debt and asset are high. And when we look at debt to equity ratio, we know the debt has gone up, equity has not gone up, so debt equity ratio will be higher, and they will be lower for operating lease as compared to finance lease. Now let us move to the next slide. Disclosures. So these are the disclosures which are required to be made by leasee and leaser in their accounts. First is the description of lease agreements. Second is the type of lease, whether it is capital or operating lease. Then the amount and timing of the lease payment for 5 years. They can be aggregated beyond 5 years as well if required. Then the lease revenue and expenses, which should be reported on the income statement each year. And then if there are any restrictions through lease arrangements, that also has to be disclosed in the financial statements. Now let us move to a new topic, which is post-employment benefits. We know the companies provide pensions, healthcare plans, medical plans, etc., which are post-employment benefits. So these are non-current liabilities. They are long-term liabilities which have to be paid when the employee is retired. They are reported on balance sheet by the company, which can include pension plans, healthcare plans, medical insurance, etc. There are two broad types of pension plans. One is defined contribution, another is defined benefit plan. Under defined contribution plan, the company provides a fixed defined contribution to a fund periodically, and in the end that fund is used to pay for these post-employment benefits. So all the risk associated with the fund has to be taken by the employees themselves. While in the case of defined benefit plan, the company has defined the benefits which will be given in the end when the employee gets retired. There all the risk of that fund are taken by the company itself, and the employees don't have any risk. The benefits which they are going to consume are already defined by the company. Let us look at other features of defined contribution plan. The company transferred specified amount in a plan known as pension expense. No further obligation for the company. Employees are bearing the investment risk. The pension expense reduces the cash on the balance sheet. The amount paid is treated as cash outflow from operating activity for a defined contribution plan. For a defined benefit plan, since there is a promise for future benefits by employer to the employee during his retirement, so the risk is taken by the company here, and the transfer of specified sum each year is known as pension expense. Here the calculation of pension expense involves a lot of assumptions. So what will be the requirements at the time of retirement? So the assumptions regarding inflation, interest rate, etc. need to be made. That is why the accounting procedure becomes complicated for defined benefit plan. Let us move to next slide. The pension expense under defined benefit plans include the service cost, which is the present value of the benefits earned during the current period, the interest cost, which is accrued on the beginning of the pension obligation, then the actuarial gains or losses which may occur due to the assumptions made with respect to the age or rate of salary growth, etc. for the employees, then the expected return on the plan assets, which should be equal to the actual return, and the prior service cost, which may arise due to the changes in the benefits promised to the employees. So all of them will be part of pension expense. Let us move to the next slide. The presentation and disclosure regarding these post-employment benefits. So on balance sheet, under both IFRS and US GAAP, the net pension obligation is reported on balance sheet. If the pension obligation is more than the plan assets, then there will be a net pension liability which should be shown, and the fund is underfunded. And if the pension obligation is less than the plan assets, since we have more value in the plan assets than the obligation we have, in that case the net pension asset is shown in the balance sheet and the fund is called overfunded. Under IFRS, the companies can choose to exclude unrecognized smooth account of actuarial gains or losses or past service costs from the balance sheet. So this is the flexibility under IFRS. The disclosures which needs to be made are the components of benefit obligation, the plan assets, and the pension expense. These need to be disclosed, and all the assumptions which are used for the calculation of the pension expense, they also needs to be disclosed in the financial statements. Now let us move to the next topic, which is the leverage ratios. Since we have seen the treatment of different long-term liabilities, so they will impact these leverage ratio. For example, debt to asset ratio, total debt by total asset, debt to capital ratio, total debt by total capital except the preference shares, then debt equity ratio, total debt by total equity, financial leverage ratio, which is just total assets divided by total equity. So any change in the long-term liability is going to affect these ratios. Then the coverage ratio. Since the treatment of interest might be different in different methods of measurement of long-term liabilities, so these ratios might also change. For example, interest coverage ratio, which is operating income divided by interest payments, or fixed charge coverage, which is operating income plus lease payments divided by interest payment plus lease payment. So when an analyst is looking at long-term liability treatment in the financial statement, he or she should keep in mind that these ratios will be affected by the treatment. So we have reached at the end of the topic. Let us take a few questions here. So this is the information given for first 5 questions. Bond issued at $1 million. Coupon rate is 7%. The market rate is 5%. What does it say? Coupon rate is more, so bond is issued at a premium. Maturity is 3 years. So what is the type of the bond? It is not a par bond, it is a premium bond, since the coupon rate is more than the market rate. So answer B is right. Let us look at question number 2, which says what is the book value of the bond on the date of the issue. So we know that number of years is 3 years. Coupon payment is 7% of 1 million. Then future value is $1 million. We have market rate as 5%. So we can put these values in financial calculator and we can find out the present value of all the future cash flows, which is nothing but the book value of the bond on the date of the issue. So which comes out to be 1,054,464.96. So which is option B. So this is going to be the book value of the bond at the time of issue. Now let us look at question number 3. It says what is the annual coupon payment? We know the coupon rate is 7%. Face value is $1 million. So what should be the coupon payment annually? Face value into coupon rate, 1 million into 7%. So which is going to be $70,000. C is the right option. Now let us look at question number 4. It says what is the interest expense for the second year? So it requires certain amount of calculation since it is a bond issued at premium. From the previous calculations, we know the present value of future cash flow or the book value at the time of issue has been calculated as 1,054,464. Then the interest payment is nothing but the coupon rate, which is same for every year, 7% of 1 million, that is 70,000. Then the interest expense for first year, which is going to be calculated at the market rate at the time of issue, which is given to be 5%. So 5% of this value is this is the interest expense for the first year. Now the difference between these two is going to be the amortization for first year, which will be the difference between these two, which is so this is the difference between these two. This amount has to be amortized, which is to be subtracted from the book value. Since it is premium, so it will be subtracted from this book value. That will give us the book value at the end of this period or the beginning of second year. So at the beginning of second year, the book value is going to be this minus amortization. So when we take the difference between these two, we get it is 188.21. Now again the interest payment is going to be the same, 70,000, which is based on the coupon rate of 7%. And now if we have to calculate the interest expense, again we are going to use 5% market rate, which was at the time of the issue. So 5% of this amount is going to be 51,859.41. So this is our interest expense for second year. And if we have to calculate the amortization, we can take the difference of these two and find out the amortization for second year. But we are being asked interest expense for second year, that is this number, 51,859.41. So C is the right answer. Now let us look at question number 5, which says what is the amount of amortization in year 3. So let us go back to the previous slide and see what was the amount of amortization. For second year it is $18,140.59. This is the difference of 70,000 and 51,859.4. Now at the end of second year, this amortization value should be added to the previous carrying value. Sorry, we have to subtract this value since it is premium. So this should reach par value. So we subtract 18,000 from this amount to know what is the carrying value in the starting of third year. So it will be the difference of these two, which will come out, which is 0.62. So this is the amount. This is the difference. Again the interest payment is same, and 5% of the carrying value in the starting of third year is going to be the interest expense. Since we are using the same market cost at the time of issuance, it is this amount, which is 5% of the carrying value. So from that we can calculate the amount of amortization for third year. For that we have to take the difference of 70,000 and this 50,952.38, which will come out to be so this will be the amount of amortization. And if we look at it carefully, the difference between these two, which will be the carrying value at the end of third year, the difference between these two is going to be $1 million, which is nothing but the face value of the bond. So that says our calculation is right. So 19,047.62 is the amortization for third year. So this was what being asked in fifth question. So 19,047.62 is the amortization, and negative sign is signifying that every time we are reducing it from the carrying value. Since it was issued at premium, so every year we are going to reduce the amortization and finally it will reach the par value. So let us move to next question now. Question number 6 says, under IFRS the coupon payment is classified as we know that coupon payment is the interest expense. It could be cash flow from operating activities or financing activity. So B is the right answer. Let us move to question number 7. Compared to the operating lease, the company which is using financing lease will report. So as we know, for financing lease, in the initial years the income is going to be lower as compared to operating lease. So A is the right answer. Now let us look at question number 8. The lessee will record interest payment on income statement as rent expense in which lease? Since in operating lease we are going to have rent, in finance lease we do not have any rent concept. So A is the right option, operating lease. Now let us look at question number 9, which says when the pension obligation is greater than the plan asset. So we have less plan assets as compared to our future obligations, then it will be termed as liability. So it will be underfunded. So B is the right option. Now let us look at the last question, question number 10, which says the debt covenants do not place restriction on. So as we know that there could be a covenant which prohibit company from issuing the additional debt, and it could make prohibitions from riskier investments, but it cannot place a restriction for issuing any equity. So C is the right option. Debt covenants do not place restriction on issuing equity. So that has brought us to the end of the topic. Thank you.